Hey, so I want to welcome everybody to our first Copperwynd Zoom update. This is our first attempt to really provide our current clients with an update via the web. I know that we had probably 70 plus people register for this today. So we're looking forward to you seeing all of us, since I know that it's been a while. I think the last time you probably saw Jake, David, Linda, and I, if you attended the first and what ended up being only spring training game that we had back in March, which seems like a century ago. And I know some of you think back and think, wow, I'm scared that we were all actually together at the beginning of March, knowing what we know now. And so it's good to have everybody here. I know that we've talked to a lot of you on the phone. We have been doing Zoom one-on-one meetings, but for a lot of you, it's probably the first time that you've seen us. A lot of us are still working from home, or at least bouncing back and forth between working from home and working from the office, probably like some of you as well. And I would expect, since this is our learning experience with Zoom with all of you, maybe a few kids or dogs in the background, maybe even a landscaper or two. So we'll try to minimize that as much as possible. So as a matter of housekeeping, so everybody's muted, but there is a Q&A function. So if you do hover over the Zoom screen, we do encourage you to ask questions. We'll be monitoring that throughout the next 45 minutes to an hour that we're together, and hope that even though we have prepared remarks, that we'll be able to interject questions that are relevant at the time. So, please, spend some time and send us those questions. So when we first started crafting the idea of let's do a webinar for all of our clients, it always comes up with what's the title of our event going to be. So I would say there were a lot of cliches that came in, which, as you can see, we picked the 2020 hindsight, 2020 eyesight. 2020 is a big year for a lot of cliches. David and I banter about a lot with movie quotes or movie titles. So we had considered calling this 2020 Armageddon. Maybe it's a mad, 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 mad world, the never ending story. The list of movie titles that represent what we're experiencing in 2020 goes on. So regardless of whether you find the title appropriate or not, hopefully you'll find the next 60 minutes with us helpful. We have tried to stay connected with you guys through monthly newsletters that we publish. So hopefully you've been able to see those on our website, log in. There's a lot of material out there that we publish monthly. We did ramp up our email communication with you as the pandemic unfolded. March, April, I think even into May, we were sending out weekly emails just with some of our thoughts. So hopefully those were helpful. And we do provide for everybody client portal when it comes to logging in, looking at your financial plan, as well as the performance of your accounts, which I'm sure some of you have been keeping track of. And so hopefully with all of that, you're feeling somewhat connected to us, but we'd love to start having this a little bit more often, and would love feedback after today's event on how this went. So with that said, I want to go ahead and kick off this meeting. So the first slide, as you can see, we are hoping to cover a wide array of topics, going all the way back to what seems like forever, back to 2019. And then in this interesting world that we live in, cover a lot of things that have occurred, and then really end with what we feel may be coming up next. And so again, the Q&A function at the bottom, if you have an opportunity to ask us questions, please do. So I'll turn it over to Jake, and he can take us way back to a time called 2019, just as a reminder of how it is that we got to the place that we are today. So Jake, why don't you take it away?
Those were the good old days, Eric, when both you and I had hair. So in 2019, right? So no, all joking aside, I actually want to start out with just a question to get everybody involved here and get a little bit of sentiment of how people are feeling about the market. But you'll see, I'm going to launch a little poll question. You'll see something pop up. We just want to know where you think the stock market will be at the end of the year. So go ahead and do your best to answer that. We'll get a sense. I'm going to actually come back to this in a little bit. So let's go back in the time machine back to 2019, like Eric said, which just seems like so far ago. But it's helpful for us to, when you look at where we're at today, it's helpful to kind of go back and say, okay, where did we come from in this case? 2019 was a really good year all around. And part of that was because 2018 was a tough year. It was a year where not very many asset classes made money. 2019 was a little different, and we ended up having part of a recovery from 2018, and then markets kind of moved higher from there. So we saw the U.S. markets, S&P was up 31%. We ended up seeing the the international markets that did well, but lagged the U.S. markets. We even saw real estate do pretty well. And the other thing is we saw bonds, which isn't normally the case. If you see a good stock market year, it's not always that bonds do well, but bonds posted a very strong number. And part of the reason for that was interest rates. I mean, at the end of 2018, the 10-year treasury was sitting around 3%. And by the end of 2019, we ended up seeing the 10-year treasury at 2%. So that was one of the reasons why bonds also did well that year as well. So as we kind of maybe fast forward a little bit and look at the beginning of 2020, at the beginning of every year, we tend to like to pull out our crystal balls and talk about, okay, what do we think are going to be some of the catalysts for this year? And I remember at the very beginning of 2020, we talked about, okay, the trade war was going on. Fed was a big talking point, the repo market, and even the upcoming election. Those were some of the catalysts we thought could have an impact this year. And very little was talked about this problem that was going on in China with this virus. And it wasn't until February where that became a much bigger problem, from it not just being a China problem, it becoming a global problem. So, I remember having a very clear discussion with David, and I made the comment when China began to do their own lockdowns. I said, man, China, that's pretty impressive that they're able to do that. I can't really see the US doing that. And lo and behold, that's exactly what we saw, not only in the US, but across the globe. And so markets began to retreat as businesses and economies shut down, and we saw the market go from an all-time high and down 34% in about 3 to 4 weeks. So one of the fastest decline from a peak, an all-time high peak that we've ever seen. But remarkably so, we've also seen the market kind of come back, and it started when the Fed, announced the willingness to buy bonds. They kind of took this do whatever it takes mentality, and that's when the market began to turn around and has come up since. The surprising part here is it normally takes about a little over 2 years for the market to go from a peak down to what we call a trough, or the bottom of the market, and then rally back. And we've seen the market do this in, just over 5 months here. So pretty remarkable.
Jake, we got a couple of questions. Thank you for those that are submitting questions. I'll summarize a couple of them together. The question's more, how is it that we have recovered so quickly from a stock market standpoint, where for the most part, I think most people that are asking questions are saying the economy hasn't recovered. Don't understand the disconnect.
Yeah, that's a good question. I mean, and I don't think this chart really tells the whole story, Eric. Maybe we can move on. Let me move on to the next slide. This probably tells us a little bit better story of what's going on. On the left-hand side, these are all returns of major asset classes, and they go to the end of July. You'll see here that the U.S. markets, have led the way. We've continued to see the international markets lag. Bonds have done really well from the standpoint of the 10-year treasury, which was at 2% at the end of 2019, has now moved down to about 0.6 to 0.7%. And we see gold be one of those asset classes that have rallied because the dollar has declined, and inflation expectations. I think this tells even a better story, which is this is the Morningstar style boxes. On this side is value stocks, this side's growth, and then top to bottom, large, mid, small. And what we've clearly seen here is large cap stocks have certainly done the best, but more importantly, growth has been the piece of the market that's really pulled everything along. Value has really struggled. And if you've been in mid cap or small cap, have struggled even more. And this disparity of returns is probably one of the biggest I've seen. This is a trend that has persisted for a while, and the gap seems to be getting larger. So what you might ask, what are the implications of that? And I think one of the implications is, the market may not, even though the market may appear to be healthy because it's come back and recovered what it's lost this year, the average stock really hasn't. In fact, at the end of July, the average stock was down about 9% compared to where the market was. And this next chart probably tells the story even better. If you look at
Jake, hold on for a second. Go back to that chart for a minute and explain how the average stock can be down 9%, but the market's up 1.45.
Yeah, so the S&P is a market cap weighted index, and what that means is more weight goes to the largest companies. And this kind of maybe ties into the slide I was just about to show, is the top 5 stocks in the S&P 500 are these. So Facebook, Amazon, Apple, Microsoft, Google, they make up a little over 21% of the S&P, and they've on average increased about 35% this year, where the other 495 stocks have declined by 5%. And I think this is important to kind of recognize that the market partly has been pulled along by some of these big names. I wasn't in the investing world so much in 98 or 99. The rest of you guys remember this much better than me, but there's some parallels that can be looked at here, where back in the 90s, the average stock wasn't doing quite as well as what the indexes were doing. And I don't necessarily think this just says that it's a negative thing, but it does bring some parallels to that. I also think it draws an interesting conclusion that the market just doesn't appear as healthy as what the index returns show. So with that, maybe this is a good time let's go back to our poll question. Here's the results from that. You should see this on your screen. So pretty, for the most part, pretty even, but it looks like lower tended to win out here, that the market would be lower at the end of the year. So we had a nickel bet on who would win. So that seems to be what we kind of.
Yeah. So Jake, you're going to be sending the nickel.
So all right, this will be a good transition to the next poll question here. So all right.
I think we want to do another poll question. So this one more on the coronavirus impact. So will COVID-19 permanently impact the way that most industry do business going forward? So first answer is nope, this is just a blip. Everything's going to go back to normal once we get over this hump. 2, partially, some industries are going to be permanently changed, but most are going to get back to normal. Or is this a sea change? Most, if not all, things are going to be done differently going forward. So interested in your thoughts on this one. These are the questions that we're putting up. We've had conversations with a number of you about this, and just thought they'd be interesting to get a little bit broader perspective from you. So Jake, I don't know if you have,
like most of the most people have answered, so I'll go ahead and end this poll. All right, here's the results of that.
And 63% overwhelming. Most people think that you're going to have most industries and businesses are going to be permanently changed. A few of you thought that it's a blip, and so only time will tell. And so maybe, David, you can kind of take us through a little bit about what we're seeing from an investment standpoint and from an economic standpoint as it relates to what really we're still in the middle of.
Yeah, well, thanks there. One of the things that we're seeing here, and this is basically looking at cumulative confirmed COVID-19 deaths per million. So it's agnostic as far as the size of the country or anything else. What you can see is early on, outside of China, when Europe started having problems, we were doing quite well. And that's even within the US. When New York and New Jersey and Connecticut and Massachusetts were having problems out here in Arizona and in Utah, everybody's like, yeah, we're doing pretty good. And then, it shifted. And so this is not, I mean, I remember SARS back at, nearly 20 years ago. And it was, oh, that's an Asian issue. And maybe it gets over here. And we put in some protocols to reduce it. And then it sort of went away. This is not. I mean, you've seen it in Latin America, you've seen it all over. And we hear people that will look and say, we have got to get, this under control at all costs. And other people that say, you've got the economy and you've got to keep the economy going. Well, the reality is those are intertwined, because this economy slowdown was not a normal recession. It was not the banks got in trouble or real estate imploded or, there was an Arab oil embargo. It was a self-imposed by the government to, try and get through this health issue. And so, it's not a either or. We've got to get through the COVID issue and get back to some semblance of people willing to and feeling comfortable going out and eating, traveling, doing business, or we'll never get back to a great economy. And so we don't look at it as, it's an either or. I mean, I don't really even look at it from a political standpoint. I look at it of let's figure out what works and what doesn't. You look down at the bottom, and we just threw in a couple of countries that have done a phenomenal job, but are still having to stamp it out a little bit. Australia and New Zealand, they hardly show up there on deaths per million because they've done a great job. Now, they're Big Island and Little Island, but Auckland is basically shut down again because they had like 20, they thought they had eradicated it basically, and they had 20 in Auckland that, ended up catching it. So this is going to impact business. And I will tell you, when people say, well, what's your forecast, David, or Copperwind's forecast here? Given what we're dealing with here, anybody that says we've looked at all the economic data and here is our analysis and forecast, they're just guessing, because there is no, looking historically what has happened. I mean, the last time you had anything like this was over 100 years ago. And it's a completely different economy and a completely different market. So as we look at this, it is about COVID in the economy and therefore in the market. But I'll talk a little bit more about, how that's impacted and where we stand. This is GDP on a quarterly basis going all the way back to the early 1950s. And so you look at 1958, first quarter went into recession, and on an annualized basis dropped 10% on GDP. Fourth quarter of 2008 dropped 8.4%. Second quarter of this year, 32%, and they revised it. It's much better now. I think it's only like 31.5%. I mean, it's just off the charts basically, because it was a hard stop. It was not a normal recession where inventory builds up, factories start slowing down. It was a hard stop. We're closing lots of parts of the economy. Now, I will tell you the good news is you're going to see a very big positive number that's going to be sort of off the charts the other way. It will probably be someplace in the Q3 of 20 some odd % increase in GDP. But let me walk you through the math of this. If you drop 33% and then the next quarter you're up 33%, you're not at even. You've got to be up 50% after a 33% drop to get back to even. So by the end of the year, even if we get a vaccine, we're probably going to have for the full year a -4, -6, -8% GDP decline, just because you shut it down. And there are literally several million small businesses that may not recover. And yet we've got areas that are doing phenomenally well. Go out and try and buy a house right now. Go and try and refinance a house right now. A lot of those things are doing phenomenally well. Go online and try and find a web camera, a webcam. All you'll see is, if anybody says they have one, then when you say, what's the ship date? They'll say November, which means they don't have it. They're just hoping they're going to get it. So there's always winners and losers when you look at this. But go forward, Jake. For those of you that have been with us for a while, you've seen this chart after the Great Recession, and it looks at how long does it take you to get back to the pre-recession employment numbers. And what you saw is basically it took 6 years in the last recession. If we get a treatment or a vaccine that gets things back more to normal, you're not going to see the Great Recession type taking forever to get back. I think you will see a dramatic snapback. Now, will it get all the way back? No, but it's going to get pretty close in the next 12 to 24 months. It's not going to be taking 6 years. That is if and when we get a vaccine or a treatment that makes this work. And when you look at those things as far as, okay, the GDP dropped, employment dropped, I will tell you an anomaly that is one of the reasons why you haven't seen the market drop as much is that in every recession we've ever had, you can go back 200 years, and what you will find is personal income drops. People lose their jobs, small businesses shut down or make less money, corporations make less money, there's less investment. From the first of the year, if you looked up until the end of July, average income, personal income for Americans went up. That's why you're seeing consumer spending still healthy. And a lot of that didn't have to do with, everybody's working. I mean, you see the numbers. You had 20, 30 million people that got booted off, but you had $600 per week up until the end of July in unemployment. And for 60% of the people that were on unemployment, they were actually making more than they were before on an after take-home pay basis. The other thing, you had the PPP loans that helped businesses. You had the stimulus package that went to individuals. So this is different than we've seen. And all it's been done has been done from the central banks around the world to the governments around the world is trying to have this bridge to the other side. And I like this graphic because it basically shows we built this bridge, but you can't see the other side. You can't say we need to get 6 months out. It may be 4 months out, it may be 14 months, or it may be 44 months. So the question is there enough stimulus in both central banks and governments to get us to the other side? And that's a question that's unanswerable at this point. But it's clear the question about why is the economy doing well on consumer spending, but really GDP's down and jobs are down, yet the stock market's at all-time highs.
Hey, David.
So let's talk a little bit about that. Somebody.
Yeah. Hey, so we have a question. This is why I love working with our clients, because they are on top of everything. And we were actually having this conversation this morning. So question comes in. So how about the new Fed announcement this morning? How is that going to affect the markets and ultimately our investment strategy going forward, given that Chairman Powell is with in Wyoming talking today?
So just so everybody knows, there's been questions historically, especially over the last decade. The Federal Reserve has said, we're going to have really low rates and we're going to keep our balance sheet very robust until we see inflation at or around 2%. If it goes above that, we're going to pull things back. And, as long as it's below that, we're going to be very accommodative. Now, what they're talking about is that they're going to allow it to go above 2%, that if it averages 2% or thereabouts over a longer time frame, they'll be comfortable with that. What that tells me is even if you end up with inflation, then what you're going to see is they're not going to raise rates. And that's going to be, that could be problematic. I mean, the problem that you always have is that you fight the latest battles. And most of you guys can remember, Jake, you can't, but that's because you were too young. But in the early 80s, when we had high inflation, late 70s, early 80s, high inflation, and rates went through the roof. I mean, we had 16% mortgage rates. So, they're basically saying we're going to let inflation run because we don't think it's that big a deal right now. And that's going to be a tough thing. And when you look at what the Fed has done, this is the Federal Reserve's balance sheet. And up to 2008, it had been running around $1 trillion. And then having to bail out the banks, having to lower rates for mortgage stuff. They bought mortgage-backed securities. They've got treasuries. And they pushed that over about a 5 or 6 year time frame. There was a QE1, QE2, QE3. They said QE infinity when they said we'll do whatever it takes. And they went about $3 trillion over that time frame to a little more than $4 trillion balance sheet. And then, they said, hey, things seem like they're all right. They let it run off a little bit, and then they put a little bit more on. And then what you've seen is this hockey stick go up. And basically what they did in 6 years of adding $3 trillion to the balance sheet, they did in about 6 weeks in March and April. I mean, it's unprecedented. And when people say,
David,
yeah,
we get a lot of questions on this very graph about, well, what does this mean for inflation?
Well, and that, the theoretical idea has always been if you print money, there's more dollars chasing the same amount of goods, therefore prices go up and you have price inflation. Yeah. Well, the difference here, we had inflation during the last decade, but people say, no, we didn't, David. I mean, it's been 2% or less. Consumer price inflation, yes. Most of these dollars that the Fed printed didn't go to regular citizens. Consumers. It went to large institutions that borrowed money very cheaply, and it went into the financial system. And therefore, what did you have? You had inflation. It was just asset inflation. It was stocks. It was bonds. It was real estate. It was gold. And that's where it's a little bit different. So if you look at the stimulus that they put on now, Jake, why don't you go to the next slide? This stimulus is the federal government. We were talking about stimulus of the Federal Reserve, which they can't directly print money and put it, with consumers, with citizens. The federal government can and has. And so, we've had the first stimulus package, they're all kinds of it, $2.5 trillion. They're talking about doing another $1 to $3 trillion if they can get their act together. And you can debate whether this was enough, whether it went to the right people. Their problem, and we've had it, this discussion with lots of people, they're saying, well, so-and-so got money and they shouldn't have got money, or they should have done it differently. In the midst of the battle, when it looked like, we were shutting down the entire economy, it was more about, let's just do a shotgun approach to get money out in the system. And you can't do the best at that when when you're wanting to get speed out there instead of efficiency. So what you've had is a huge amount of push with the Federal Reserve, pushed up risk assets, especially, the stock market and the bond market. You've had a huge amount of the federal government pushing money out to the individual consumers. So we're not in a huge world of hurt right now from when you look at a lot of the economic data. But the question is that bridge long enough and far enough to get to the other side? And that's an unknowable thing right now. But the trend clearly is positive from that standpoint.
So we got another poll coming up, and actually there's a couple of people that have commented through the Q&A. And so Jake, why don't you put this up? Because I think it is in line. And so the question this time for you guys is, does the stock market rally more with a Republican or a Democrat as president? So either Republican rally, Democrat rally, or doesn't have a material impact on who's in the office. And some of the comments that have come through is, if you go back to our previous questions, are my answers will change depending on who's in office. So you're asking some longer term questions. Where does the stock market end at the end of the year? What does industry look like as it relates to COVID? And the people that came through are basically saying, I'm not answering because I don't know who's going to be in office.
Right. So looks like we've gotten most in there. Let me just end this polling. All right, that's what we got here.
All right. Does the stock market rally more and so it rallies so Republican at 49 and doesn't have a material impact on the stock market. So let's show them the chart, the next chart, Jake.
Okay.
So this goes back to the 1950s, and the axis on the left side is the annualized stock market performance as a percent. So from -10 all the way up to +25. The bottom is the GDP growth from 1.5% all the way out to 5.5. So what you really see here is those that say it doesn't make a big impact. That's the real answer over the last 70 years on the stock market, because what you see is somebody like a Kennedy or Johnson during the go-go years of the 1960s during the Vietnam War had great GDP growth, but sort of average growth in the stock market. You had Gerald Ford during the 70s, which was not a great time. The economy grew all right, but he had phenomenal growth in the stock market and didn't get elected. He was never elected, so he couldn't get reelected. He was appointed after Nixon. But what you see is there's not a good pattern, and we've said this when it's come up in our discussions with our clients as we've gone through it. It's more important what the Fed is doing and where we are in the market cycle. If the Fed is tightening, it's going to be a problem. If the Fed is not, if they're loosening and being accommodative, it helps the stock market a lot. Here on the left-hand side is the chart, and you'd say, oh yeah, I remember that. That was stock market in March. It wasn't the stock market. This actually was a bond fund, an investment grade bond fund, an ETF, LQD. So it's large, well-run, lower risk bonds for U.S. corporations dropped 20% in less than a week. At the bottom, the Fed realized what was occurring, that it was a liquidity issue, not a credit issue, stepped in and said, we'll buy the bonds. And voila, in one day, half of that got erased. And within a couple of weeks, you had done a great job of recovering all of it. And that is where, when we look at the investment side, we feel more comfortable right now on where we are on bonds because we feel the Fed has our back there. The Fed's not buying stocks, but they are buying bonds. And so we feel more comfortable there as far as from a risk standpoint. And what you see on the right-hand side is basically the Fed saying, we're going to do whatever we have to. And Eric has talked to us before and said, I believe that we're going to get to negative interest rates like Japan and like Europe. And I can't disagree with that. I mean, I don't think it's a good thing, but I can't disagree, with what is occurring there. Now, I meant to say something when we were back looking at the chart on the presidential stuff. It does matter who is president. What I meant by that, because who our judges are, what the regulation is, our foreign policy, all of that does matter. That's not what we're trying to say. And we try and stay out of the politics of it because we're managing the investment side. That's And that's what we're saying here. But looking and saying, I'm going to use who's the president as whether I'm going to be in the stock market or out of the stock market, I will tell you, bad timing tool for that. So
we got a couple of questions. I think
okay.
as we transition, I think we're gonna hear from Linda as well. And so I'd love both David and Linda's comments on this. So one of them was, so what do you think? So we've been talking a lot about the government, right? So either Congress is sending out a lot of money to the citizens, and the Fed is printing a lot of money. So what do you think about the current private debt levels, meaning companies in particular, it's not necessarily households, because I think we've seen, and maybe this was implied in the question, right? We've seen a lot of companies issuing a whole lot of debt at really low rates. Do you feel like that's a good thing? Is that something that will hinder us over the long term?
Well, Linda, you can step in here too, but I mean, when I look at it, if I'm the CFO of a company, I look and I say, this is the time that I would lever up, because companies don't go bankrupt because they have too much debt. It's usually, I've got debt and I have a credit problem when the markets are not accommodating. And if I can borrow money at 1%, 2%, 3%, 4% money for 30 years, why would I not do that? Because especially, so if I'm CFO of a company and it's an investment grade company and I'm paying a dividend of 3%, and I can go out and borrow money that is tax deductible and pay 2.5% interest, and I can take that, or even pay 3.5% after taxes, I'm paying 2 and change. I can take that money, go buy the stock back, I increase my earnings per share, reduce my cash, increase my cash flow. I mean, it makes perfect sense. Where it doesn't is where you start to see acquisitions where I go and I pay, 40 times earnings for another company and I borrow the money to do it. That's when you end up with problems.
Well, and we saw this after 2008 when the Federal Reserve was printing money back then. And interest rates were really low. What we said was, you have a misallocation of capital, right?
Yep.
You have companies doing things and buying things that in a quote unquote normal world won't make sense. The other thing that if you look back at the markets from 2008 until present, a lot of the performance on stocks was exactly what Dave was talking about, the stock buybacks. Right. Yep. So again, misallocation of capital. Does buying back your company's stock present a value to the shareholders? Hard to say that that's a valid use of those funds. You're not employing people. You're not growing your business. You're just simply buying back your stock.
Yeah, it's interesting. I was reading an article last night by one of the big fund companies, and one of their analysts was saying that you shouldn't use bonds anymore for income. Just go buy good dividend paying stocks. And I thought, how far have we come? You buy a bond because you said, I don't want to take a lot of risk. And somebody says, oh yeah, but you can get 4%, dividend on that. Great. You go back to Jake's chart and that stock's down 25% and was down 45% in March. You're going to panic. And that's where, Linda, you're exactly right. It's misallocation of capital. Even on the investor side, people look and say, well, I used to get, a year ago, we could get you 2 to 2.25% in a T-bill fund or buying directly T-bills. No risk, you make 2.25. Today, that's 0 to 0.25%. And so people are then stretching, and that's always the risk. When you force people to take more risk than they should, then that's when things can blow people up. And one of the things we always say is risk is something that you realize you took too much of when there's absolutely nothing you can do about it.
So what do you think about forward growth on the markets then, and with this as a backdrop?
Well, so one of the things that we look at is there's lots of forecasting models out there of what's the market going to do over the next 5, 10, 15, 20 years? Usually people look at a 10-year type time frame, and you can look at price to earnings ratio. Warren Buffett looks at one of stock market valuation, total stock market valuation to GDP, dividend yield, economic, where we are, all those types of things. And this is when you look at those, and we've taken 5 that are readily available, have good track records, but look at different things to say, here's what we forecast the next 10 years to be. The average of all of those 5 is 6%. Over the last 140 years, you can see the numbers, the average stock market return has been 9.2. So what does that tell us? It tells us not that the market's going to be only at 6% a year. It says on average over that time frame, you're going to get sub-average returns. Are there years that we're going to make 30% over the next decade? Probably so. Are there years that we're probably going to lose 10 or 20%? Probably so. But on average, the returns are not as good as historically you've seen. And I'll give you a perfect example of that going back in recent times, not back to the 1929 crash or anything like that. 1982, we went through 1981 where mortgage rates went to 16%. You invest in the stock market, the S&P 500, and over the next 18 years, you end up getting 16.5% average annual return. Great bull market. You buy the NASDAQ, though, in March of 2000, it takes, at one point, you're down 80%, and it takes 15 years to get back to even. I'll give you an international example of that. 1989, if you remember back in the 80s, Toyota, Honda, Sony, all of them had it figured out. They bought Pebble Beach, they bought trophy, real estate all over the US. The Nikkei, which is sort of the equivalent of our Dow or S&P, was at 39,000 then. Here we are 31 years later, it's basically half of that. So think about that. What if our stock market was half what it was 31 years ago? So we're not saying that's going to occur at all. We're just saying you have to look at where we're at all-time highs with valuations that look really stretched. And as we sit down with you and go through the retirement cash flow model, we're probably going to be showing you some numbers as far as the scenarios we run at lower rates than we would have 5 or 6 years ago.
And part of that is due to the fact that we have low interest rates as well, right? So on the bond side, you're not going to be able to pick up as much as you historically might have.
Well, just like you said, Jake, 2 years ago, 10-year was 3%, and now 10-year is 0.6, 0.7%. I mean, think about that. Even the 30-year at 1.45%, you're lending the government money for 30 years, guaranteed that after inflation, basically, you're going to lose money. I mean, it's crazy. When the mad world that Eric talked about is that's exactly where we're at. But you have to look and say, what do we do? And I will tell you, one of the things that that people talk about, they say, well, doesn't this look like a bubble? Yeah, it probably does. How long do bubbles exist? If everybody remembers back, irrational exuberance, so you've heard that numerous times, it was attributed to Alan Greenspan when he was talking about the tech bubble and he was talking about the NASDAQ. And you look and you say, okay, so he knew there was a bubble in 2000. Well, yeah, I'm sure he did. But he actually made that statement in December of 96 when the NASDAQ was 1,300. And by 2000, March of 2000, when it did start to burst, it was over 5,000. So 3 of the best years the NASDAQ ever had occurred after he said there is irrational exuberance. So the trend is your friend. And as you've seen, we've gone back in and we're fully invested. And we'll talk a little bit about that later, but it is a different time. I think you do have to look and say, what is the smart thing to do here, and not say, what should the market do? What should the economy do? You look and see what it's doing, not what you think it should do. Linda?
Well, how about we take a look at how we have done, right? So as most of you know, if you want to head over to the next slide there, Jake. This chart's going to look familiar to all of you. Right? This is our portfolio lineup of the models that we have created. Lowest risk on the left, highest risk on the right. What I want to do is just, let's take a look at some of the portfolios that we actively manage. Now, most of our models have some form of active management, whether it's protecting on the downside to avoid risk, or it is providing some alpha or growth on the upside. What I want to show you is on the total return portfolio, AKA our bond portfolio, an example of how our models behave during this pandemic and the crisis earlier in the year. So what we see here is that as the market started to become volatile, our models triggered a sell signal on our high yield bonds. In fact, almost everything in the bond portfolio, but this one started on February 27th. So we actually exited our high yield bond position on February 27th. And then, as David talked about earlier, with the Federal Reserve stepping in and effectively backing the bond market, that caused prices to stabilize, and our models then signaled a return to investing on April 9th. The net result is we were able to sidestep, as you can see on this graph, a lot of that downside. So instead of high yield in your portfolio being down 2.25 to 4.6 for the year, we're actually positive on high yield and positive on all the bond portfolios as a result. Now, bonds move kind of slow. Stocks move a lot faster. Were we able to have the same success on the equity side of the equation? This is our core portfolio, what we call our growth strategy. And here we use very different metrics, and we use a series of steps out of the portfolio. And again, you saw those steps start to trigger sell signals as early as, I think it was the 25th of February was our first sell signal. And we step out in 3 logical moves in this case. And then as prices started to stabilize, we step back in. So here what you have is the S&P is the orange. You see how ugly it got. The blue line is our growth portfolio, and you can see exactly what happened, and that is that it preserved a lot of your portfolio during that period of time. And then as we got back in, we've provided some nice incremental growth above and beyond where the S&P is. Now, you'll note in both cases with these active strategies, they are not predictive, right? We didn't get out at the top and we didn't get back in at the bottom. These are intended to follow along, they're trend following. And so we're never going to totally maximize it, but obviously it was a great result for all of you in those strategies. And that's not to say that every strategy behaved as perfectly. Right? We have a number of different strategies that have different triggers, both on buys and sells. And that is why we diversify your portfolio and putting a mix of different models in place, depending on your risk tolerance, your investment objectives, your tax needs, etc. But that's on the protection side. Now, how about on the growth side? Well, one of the strategies we developed in 2012 is the momentum strategy, or the 5-stock strategy. Definitely our highest risk strategy. I mean, it's only 5 stocks, so that makes sense. And our expectation would have been that this did not do as well during the correction because, well, we've seen it in the past, and it's 5 stocks, and that which goeth up quickly cometh down quickly. And for those of you who've been around not all that long, you will remember perhaps October of 2018, where this strategy lost 20% in a single month. So it can be fun on the way up. It can be a bit scary on the way down. And our expectation going through this would have been, since it's the highest risk strategy, that maybe we would see a worse than S&P result. And in fact, it held its own, right? It stuck with the S&P through most of the correction. And then once prices started to stabilize, it's just been off to the races with huge outperformance this year. So that's not to say that the happy coincidence, I should say, is because going into this crisis, it was already in technology stocks. And as we know now, that's been largely what has led this market forward. So it worked out very well for everybody in their portfolios this year. Now, I have been asked a couple of times, do we have COVID stocks in our portfolios? And I think going back to the question, everybody thought there was going to be some very fundamental shift in the way we all do business and live our lives. We've certainly seen a pivot in this market and some winners and losers. You will see in various individual stock strategies, we've obviously picked some of those up, whether it's Lululemon because of the at-home gymnasium interests, if it's NVIDIA and AMD and Tesla because of the interest in the transportation as a service. We've got Regeneron and Abbott and Pfizer all in the medical field as part of the vaccine and treatment for this pandemic. So there have definitely been some big winners. And I think that's reflected in either your individual stock strategies or in the strategies that offer ETFs, but seem to have picked those up as a part of the momentum that has been in this market this year as well.
So Linda, it seems like this market created quite a few opportunities on the investment side. What have we seen on the planning side? What have you seen there?
Well, and again, we've had some legislative changes and we're anticipating some changes, right? So the first obvious one Jake was talking about earlier, we've seen the 10-year Treasury drop to 0.7%. I think it's 73 basis points today. Well, what does that have to do with you? Well, there is an opportunity there. And that's because that's the interest rate that drives the mortgage rate. And I confess I'm amongst the millions of people right now doing a refinance because the mortgage rates are at historic lows. And if you have a need or opportunity to refinance, I think this is an excellent time to do it. I don't know how they get much cheaper. Of course, I've said that before, and here we are. So, but yeah, I think we're sub 3% for sure on the 30-year mortgages, which is just crazy.
Yeah.
So the other opportunity aside from the interest rates is a Roth conversion. Well, why would I think about doing a Roth conversion in this world? Well, if you reflect back to the chart that David showed you earlier on the debt of the Federal Reserve, so that just doesn't get to sit on their balance sheet forever, right? At some point, we all know somebody's going to have to pay for that. And usually what we think of when we think of paying back debt is that means that we're going to get taxed at a higher tax rate. Regardless of who is going to be in the White House this fall, the fact of the matter is that the Tax Act of 2018 sunsets in 2026. So at some point, we are all going to be paying a higher tax rate than we are now. In conjunction with that thought, we also had the CARES Act in March that went ahead and eliminated or waived the requirement to do required minimum distributions for 2020. So for those of you who are of an age where you are starting to take your required minimum distributions, unless you need those funds for your day-to-day living, we're going to be talking about this through the end of the year with you about taking the money and out anyway, but not as an RMD, but actually doing a Roth conversion. If we think taxes are going up tomorrow, we're better off paying the taxes today and converting that and putting it into our never tax bucket. So those are some of the things that we're going to be talking about between now and the end of the year. We still have some runway left, right? These were not conversations we were having with you in January of this year, but life changed along the way. We still have a little runway left in 2020. There's bound to be some changes coming out of Washington, whether it's additional stimulus, new policies, new tax rules. There's plenty of time for things to change. So I think the question then would be, do we think we're going to get a bull or a bear out of the rest of this year?
So before we jump into kind of this last slide, although I want to definitely leave it up and running, so Jake, you can continue to push that. A couple of questions that have come up, I think that we can wrap in on. So the concerns of the volatility in the stock market, whether this is long in the tooth, and knowing that we're going into an election that is somewhat undecided at this point. A lot of questions are, what about gold? What about silver? What about real estate? Are there other investment opportunities that maybe we're not investing directly within their portfolio? And so I think any short answers to those when you look at all, I wouldn't call them necessarily alternative, but outside of maybe what we're necessarily managing. And then we've got about 5 minutes to bring this to a close.
Well, I think when you look at some of those, it's all goes back to it depends. If on real estate, if you're looking and saying I want to buy an office building, an office building in Manhattan or San Francisco, probably, going to be some big changes there. If you're looking and saying, I want to refinance or buy another house, lots of different opportunities there. On gold and silver, I mean, that had a great run this year. The question is the Fed, actually going to let inflation go up, which would help those, or is that just what they're saying right now to keep the markets calm? I mean, it all depends upon the individual situation, what your assumptions are.
And I think to the real estate market, at least on the individual level, the problem we have right now is we're kind of living in a state of suspended animation. There's the eviction moratorium is preventing properties from coming on the market. It's supporting rental prices. It's supporting housing prices because there's very little inventory. So until that market is allowed to function freely and we start to see who's really swimming without trunks, as Warren Buffett liked to say, then I think we probably are a little more cautious on real estate in spite of its frothiness right now.
I remember Lynn and I, when we actually were in the office, this distinct conversation about, because we both own real estate outside of our primary residence, about what's the downside, what's the event that occurs that would cause you to not own your rental property anymore. And it's one of those things where you give that answer within the world that you know. And I don't think, and I know that at that time, there's no way we would ever thought, well, if the government makes it okay for nobody to pay rent, the government makes it okay that nobody can get evicted, that would be a scenario where it's like, geez, I don't know if I want to own rental property during that time. But that's not something I think when we discussed when would be a bad time to own real estate. And that is the mad world we live in on what could possibly come next with a new or same president, a new or different Congress, on what are those laws. Because, and I remember, David, I think when we first started working together, it was everything's out the window. Whatever I thought was possible or known from 2008, we threw out the window. And now it's like, geez, you add 2008 to 2020, it's like anything's possible. And so it is hard to say this is a great time for everybody to buy X.
Well, it's funny you say that, Eric, because Eric and I, we always go back and forth on movie quotes. And the movie quote that comes to mind is in Princess Bride, where he says, "Inconceivable." And he says it throughout the movie. And every time one of these things come up, I think of that, inconceivable. So it is crazy. It's a crazy world.
So I want to kind of wrap this up. So we put this slide out for some bullish and bearish scenarios on what would occur, what would need to occur for the market to continue. And we're talking stock market at this point, but for the market continue to go higher. And on the right-hand side, what are some of the things that would occur that would potentially, we could see a small to medium to large pullback. And so I want to kind of go around the room, not only relative to this slide, but give everybody an opportunity to provide some closing comments. And I know we haven't gotten to all the questions that have come in. I'll say it a couple more times. Thank you for all the questions. We'll follow up with you. This is recorded. We hope to send this out because I know we had a lot of clients that couldn't make this time. So with that, David, why don't you put a wrapper on your thoughts on today's session?
I'll make it short and sweet. I know Linda doesn't believe that I will do that, but I actually will. Our graphic of the bridge, that's the bullish scenario, that we get to the other side. If we don't, it's a very bearish scenario. I think, and I tend to be positive. I think we get there. If we don't get there, that's the problem.
Linda, any thoughts? And that was actually, I'm impressed. That was actually short.
So I think that the next pivot point here is what happens with the drug studies, right? We have 3 companies right now here in the United States who are, well, I guess technically AstraZeneca is not in the United States. 3 companies who are in phase 3 clinical trials. We will start to see the results of those clinical trials end of September, beginning of October. Positive results, positive impact from those trials. I think this market, believe it or not, has tons of room to run on that euphoria and optimism. If we don't see positive results out of those drug trials, I think some reality starts to set in, and we probably see volatility and correction, especially because it's just a month before the elections. So I think that's the next thing that I'm watching for anyway. Jake?
Yeah, this 2020 has just been a challenging year overall. It's just been bizarre. And, collectively, we've had to, go through this pandemic together. We've had to, worry about stock market instability or high unemployment or social unrest, all these things, right? And I think we're bombarded a lot of times with the negative side of things. We get information thrown at our face all the time, right? And sometimes it's hard to look through that a little bit. And I'm kind of with you, David, in the sense that I try to be more optimistic. And right now we have a very strong trend. And, I've heard a saying a couple of times that when you're in a strong market or in a good uptrending market, the market never lets you in. And when you're in a strong downtrending market, the market never lets you out. And I feel like we're in a very strong uptrend at the moment. And I don't think we can discount all the negative things that are mounting, but I think that makes a strong case for the way we do management, which is having some type of downside protection and not feeling like you always have to just ride things out. So.
So I'll finish up, and Jake can advance it to the last slide. So as the Chief Compliance Officer, my closing is always, I'm going to read you all the disclaimers and disclosures that we have about but I'll refrain from doing that. So more on a serious note, I know for every single person on this call, 2020 has not turned out anywhere close to what we thought it was going to be, whether it's where you live, what vacation you thought you were going to take. Doesn't matter what side of the political aisle you sit on. It's a whole lot different than we expected now that it's August. I will say that at Copperwynd, we are hyper-focused on just making sure you, your family are still focused on that long-term financial path that we helped hopefully build before all of this happened. We're going to obviously need to make some adjustments going forward, but we've all been through this before. Again, kind of going back to the things that we've touched on already, the oil embargo in the 70s, 80s inflation, crash of 87, you name it. And those were very challenging times, but we've all made it through that. And the challenge right now is that we're still in the middle. We don't know what's on the other side of that bridge. So I tell my kids that all the time, is that it's going to work out. It may not work out how you thought it was going to or how you wanted it to, but it will work out. So with that, again, I want to thank everybody for your time and attention today. I hope this has been helpful. If we didn't answer your question, again, don't let us off the hook. We'll get back to you. Any questions or comments you have, please reach out. We are hoping to send a survey out so that we can improve on this going forward. We hope to do this on a little bit more regular basis. Again, it's recorded, so we'll be able to send this out so you can watch it over and over and over again. Again, thank you. Hope you have a wonderful rest of your day, and we'll talk to you all soon.